Welcome back to the Infinite Banking Versus series, where we break down financial strategies to help you make smarter money moves. Today, we're comparing the infinite banking concept to a very popular savings tool. This is the Certificate of Deposit, or a CD, which you can get at your very own local banking institution. Now, if you're wondering whether locking your money up in a CD is the best way to grow your savings, then you'll absolutely want to stick around for this discussion.
That's right, Jonah. So today we're going to evaluate both options using our core 8 ideals: guarantees, constant compounding, liquidity, flexibility, privacy, taxes, rate of return, and passive income stream. By the end, you'll know how these two strategies stack up to one another. And hey, if you're finding this information helpful, please don't forget to hit that like button and subscribe for more financial insight.
All right, Sean, let's kick things off with a bit of history. Certificates of deposit, or CDs, have been around in the US since the early 1800s. They were created as a safe way for people to earn interest on their savings by locking their money up, but only for a fixed period. So sometimes this can range from just a few months, 3 months, 6 months, to a couple years, 1 year, 5 years, things like that. In return, banks are going to offer a guaranteed interest rate and a return of your funds at the end of that fixed time period.
You see, participating whole life insurance is the foundation of infinite banking and has been around for well over 150 years. Mutual companies like National Life and Mass Mutual really pioneered these styles of policies, offering stability to their customers through profit-sharing dividends. Although utilizing the product of whole life insurance and accessing the policy's cash value is something that the wealthiest families in America have been doing for quite some time now. But infinite banking as a concept was actually popularized in the early 2000s by R. Nelson Nash when he started helping individuals understand how to leverage the policy's cash value as their own banking system.
That's awesome. Sean, why don't we hop into the comparison and start with one of our favorites that I know is a foundational piece to both of these products, and that is guarantees. CDs offer a guaranteed interest rate, which is one of their absolutely biggest selling points. No matter what happens in the market, you'll earn the promised and guaranteed rate. However, those rates tend to be on the lower side, especially when inflation is really high. If you want a slightly higher rate, you'll have to be willing to lock your money away for a longer time period. Generally speaking, at your local banking institution, or credit union, if you do inquire about a CD, you'll notice that the lower rates are on the shorter time periods and the bigger, higher rates are on the longer time periods.
Jonah, you know how much I like guarantees, which is why I can tell you without hesitation that infinite banking policies also provide those same type of guarantees. Your cash value grows at a guaranteed rate, and all the companies we work with offer dividends that can actually further enhance your policy's growth. Now, to be clear, dividends are not actually guaranteed, but we only work with companies with a track record of paying them for over 125 plus years straight. So, like I said, it's not guaranteed, but it's as close as you can be. The difference between these two is that these guarantees are designed for long-term wealth building rather than short-term savings.
Not bad, Sean. How about we move on to constant compounding? CDs offer compounding interest, but of course only within the fixed term of the deposit. Once the term ends, you either have to renew the CD, do it again, or just withdraw all the money, which of course interrupts, stops, it completely shuts off your compounding. So compounding interest, yes. Uninterrupted compounding, no.
Funny you mention uninterrupted compounding interest, Jonah, because that's exactly what infinite banking provides. Uninterrupted compounding, meaning even if you borrow against your policy's cash value, the policy still continues to grow as if the money was never touched in the first place. I hope you guys understand how huge of an advantage this is for building wealth over time.
Sean, that is a pretty powerful feature. So when it comes to liquidity, this is where CDs begin to drop the ball a little bit. If you need access to your money before the term ends, you'll likely face early withdrawal penalties. So in simple terms, if you've signed up for a 1-year CD, but you need to go access the money after 6 months, there's absolutely going to be some early withdrawal penalties. CDs are just not your go-to vehicle if you're looking for liquidity, which makes them far less flexible in the case of an emergency or a big investment opportunity that you're ready to jump on.
Okay, so CDs are not great when it comes to liquidity, duly noted. When it comes to infinite banking, your policy actually offers near immediate liquidity through policy loans. We like to say within the first 30 days, just to be safe. Another great feature is that you can actually access your cash value without any sort of penalties and use it for any purpose, no questions asked, making it a much more flexible and liquid option compared to some other counterparts.
Liquidity is definitely important, Sean, but let's transition into now what I like to call flexibility or use. So when it comes to CDs, they can be pretty rigid. Once your money's locked in, you can't easily change the plan without paying penalties or accessing the money like we just talked about. Now, you do have the ability to use the money earned from the CD in any way you choose, but you will have to be prepared to pay taxes on those earnings, which is something that we'll discuss shortly. So how does flexibility of the infinite banking concept stack up, Sean?
That's actually a great question, Jonah. So infinite banking policies are uniquely designed for that flexibility. You can borrow against your cash value for investments, emergencies, or even large purchases, really anything you'd like. Plus, you control the repayment terms on the loans that you decide to take out. I can't think of any other vehicle out there outside of the life insurance realm that lets you dictate your loan repayment schedule, or even if you want to repay the loan back at all. That's what I call flexibility.
I absolutely agree. So I think it's time that we actually discuss privacy, something that I think is important to everyone these days on some level or another. Now, I'm sure you guys are aware that CDs are bank products and they're subject to the regulatory oversight. And while your savings are secure, there's little to no privacy when it comes to financial transactions around these products.
I do enjoy my privacy, Jonah. So when it comes to infinite banking, because we're dealing with a life insurance product, privacy is actually a key component. For example, all of your transactions are private, 100% private. I'm talking about policy loans. Those don't even require any sort of credit check or any sort of external approval, meaning they're not going to show up on any database. Unlike if you decide to take a loan from, I don't know, really anywhere else. Also, the majority of states view this style of product as an asset that can't be touched through liens or lawsuits, giving you greater financial confidentiality and that feeling of safety.
I think that might be a big one for a lot of people, Sean. Another big one that I had briefly mentioned earlier, but I know everyone is of course always interested in, is taxes. So your interest that you earn on a CD is taxable as ordinary income, which can and will eat into your overall returns. There's no special tax advantages or code unless the CD is part of your retirement account.
Oh, taxes. Who doesn't love talking about taxes, Jonah? Luckily, I do, because infinite banking policies grow tax deferred, policy loans are tax-free, and the death benefit is paid out tax-free to your beneficiaries, which means when I'm gone, everything I'm leaving behind not only doesn't have to go through probate, but my family will receive every single dollar tax-free. That's what I call a tax-efficient strategy.
Agreed. Now, the next ideal is often a big topic of discussion for people, especially those who focus on investing, and that is rate of return. Now, CDs are not generally known for super high returns. In most cases, the interest rate barely keeps up with inflation, which can erode your purchasing power over time. Although it's possible to get a small but decent return with a CD, because the money's locked up, you can't use it anywhere else, and you don't have the ability to take it and go make more money with it, so the overall growth is just overall somewhat limited.
Now, I just want to clarify, when discussing IBC, if your focus is on rate of return, then we need to continue with your education process. But for the purposes of this video, I'll just say that infinite banking prioritizes steady, predictable growth. And while it may not offer high returns in the short term, the combination of guaranteed growth and your potential dividend often outpaces inflation and builds wealth long term. Now, I will say what you do with the money in your policy, that's what matters. And that's when and where we as borrowers begin to focus on the topic of rate of return.
Well said. So the last point that we like to compare and consider is the potential for a passive income stream. CDs can absolutely generate passive income through the interest payments, but that interest and the income is limited by the low rates and the fixed term of the deposit. And of course, if you want passive income from a CD, that also means you've got a pretty big chunk of change that you've locked up inside that CD in order to get it. You'll also need to end up considering the capital gains tax that you'll be required to pay on the growth of your money. And of course, like we talked about earlier, just the general ordinary income tax.
That's definitely good to know, Jonah. So to wrap this up, at least on my end, infinite banking policies can create passive income streams through strategic policy loans or withdrawals in retirement. Because the cash value continues to grow, you can actually rely on a consistent stream of income without completely depleting your assets.
Well, thanks for watching. It sounds like CDs are great for short-term savings and minimal risk, but they're not really designed for long-term wealth building. Their low returns, limited flexibility can really be restrictive for many investors, and due to the lack of liquidity, some people might just decide that, you know what, CDs just aren't for me.
Infinite banking, on the other hand, Jonah, offers long-term stability, growth, and financial control. So for those who want to actually build wealth while maintaining access to their money, it's a powerful solution and it might be worth looking more into.
As always, we're here to help you decide what's right for your personal situation. So if you're interested in talking to us, then what you should do is use the link in the description of this video to book a call. This call's free, one. And second, it's individualized, like you'll really get me or maybe even Sean, and we can dive deeper into your overall goals.
As always, guys, thanks for watching. Don't forget to like, subscribe, and hit that notification bell so you never miss a new episode. If you found this video helpful, please feel free to share it with a friend. And if you got questions, we'd love to hear from you in the comments below. Don't forget to go check out our other videos in the IBC Versus series by clicking right here, and we'll catch y'all next time. Peace.